Hello and welcome to LUMA's first ever video market report. I'm Connor McKenna, VP at LUMA Partners, and I'm thrilled to be joined by our founder and CEO, Terry Kawaja. Terry, how you doing?
Hey, Connor, good to see you. Over Zoom as always.
Of course, the only way we see each other these days. So we've been doing this report now for just over 5 years, and we typically, post a PDF a couple days after the quarter closes. We may do an interview or so too. But it's always been difficult to really capture the nuance and context of what actually happens in a quarter in a concise market report. So given we're all at home and can do this over Zoom, thought we'd do something a little new here and experiment with video as well. So we will still be posting our typical report to our website at lumapartners.com. You can sign up there to download or sign up for our newsletters, but we're adding this video component to give a little bit more context. So we hope you enjoyed this experiment, and please do let us know if you like it. All feedback is welcome. And without further ado, let's dive in. So just to set the stage before we jump in, as is typical, we really focus this report just on where we as LUMA focus, and that is at the intersection of media, marketing, and technology, or more specifically, ad tech, martech, and digital content. And more recently, we've added in direct-to-consumer brands as, while not directly at the intersection here, are companies that have really been leveraging a lot of this technology, very high growth, and having lasting impact on what's going on in the marketing and media ecosystem. So unsurprisingly, in Q2 2020, through this COVID crisis, M&A is down. It's down over 50% year over year in Q2 and continues to be down from what started off as a very tough quarter in Q1, which really happened in March once COVID got into effect here. So, LUMA, we're an M&A shop. So Terry, I guess the first question is, should I be dusting off my resume? What's the future of M&A look like?
Yeah, we picked a hell of a quarter to launch this video product. No, I think you're fine, Connor, on the resume front. And here's why. Look, this headline is no surprise, right? When you've got a lot of uncertainty in the market, M&A is a large investment that's a function of confidence. And where there lacks confidence, because you have no clarity on what the future looks like, people are naturally gonna pull back. They just want to see what's going to happen. And remember, it feels a lot more settled now, but in the days of, March and April, things looked A, dire, and B, really uncertain as to where we were going and how bad this was going to get. And so it's not a surprise that we've been on pause. We've kind of been on this 90-day pause while buyers are trying to get their bearings. But we have noticed in the last, I'd call it several weeks, so it's fairly recent, a return to dialogue. And look, there's a pipeline here, right? The first dialogue has to pick up in order for deals to manifest themselves. Of course, they get the term sheet, which gets negotiated, then a contract. So there is this lag period from dialogue to negotiations and ultimately to an announced deal. But the good news is we've already seen the first part of that kickoff, which gives us a good feeling for Q3 and Q4.
Yeah, and while that's been down across the board, there have certainly been some bright spots, whether it's digital content and direct to consumer. But why don't we dive into each sector specifically and add a little more context there. So ad tech, unsurprisingly, has been one of the sectors that's been more dramatically impacted by this. Both in Q1 and in Q2, we saw no scaled transactions, that is transactions over 100 million in deal value. And we also saw a big drop off just quarter over quarter as the 7 deals dropped to 4. As unsurprising here, because ad spend is typically hurt in a recession. It's a variable expense for many corporates, so they're able to pull it back quickly. And just recently, a marketer actually adjusted their forecast for digital ad spend in the US from 17% growth this year to 2%. So about $20 billion of potential ad spend quickly left the coffers for digital ad spend. So what's going on in ad spend? What do you expect to see happen here?
Yeah, well, I think the real takeaway from that number is that it's still positive. So they're expecting growth in digital ads for the year 2020. If you look at ad spend writ large, we're still talking, I've seen forecast for U.S. spend in total for the year being down anywhere from mid-single digits to slightly into double digits. In other words, less than the financial collapse 10 years ago. So net, it is looking like, and look, there's the other half of the year to still has to, come and go, but the, forecasters are saying it just isn't going to be that bad. Now, of course, that's a total number. It'll be very uneven. There are sectors like travel where, spend is way off. So it's not evenly distributed, but I think the fact that the impact is as tepid, is as limited as it is generally speaking good news. And while we're going to be down a bit, certainly in the second quarter, I think that's going to set things up such that the back half can grow nicely, and that'll be a good thing. We'll be into accelerated growth in the back half of 2020. Fingers crossed, assuming that we don't continue in this, ridiculous sort of first wave, sort of continuation. I think the only other thing to notice, and we'd be remiss, we didn't mention it, here we are on the eve of July 1st of Q3, where there has been a movement to boycott Facebook, either for the month of July or for the rest of 2020. And what started off was a few sort of, ethically progressive brands indicating they weren't going to spend on Facebook under the guise of, hashtag stop hate for profit. That has now ballooned into major global brands. Look, you could cut this two ways, right? Obviously, the aggregation of even all of these big brands, not going to make that material an impact for Facebook since it garners most of the revenues from the long tail. That said, I think it makes a difference. These are statements that major CMOs are making that they want change. And I suspect if this continues, we will indeed see Facebook make some changes.
Yeah, definitely. And both, interesting how much the duopoly is getting hit here. You mentioned the Facebook stuff, and I think underlying some of those numbers on the spend coming down is travel, as you mentioned. And what's that massively impacting is search, right? And who searches Google. And so while I certainly think no one's expecting Google to be overly hurt here, it is interesting given the last financial crisis where search was the one area that wasn't touched because everyone needed to spend to the efficient frontier. Just when you take out one of those industries, it's hard to continue to spend. The other interesting thing here around ad spend or ad tech, and I think you and I noted this back in Q1, is the acceleration of trends we were already expecting. And at the end of Q1, we're a couple weeks into this COVID crisis, but it seems that those are even expanding. So whether that's usage around convergent TV, and whether that's consumers using it or really businesses needing to tap into that, as there's no live sports, which was the stronghold of linear TV, as well as e-commerce, as more and more people continue to use it, which will mean there's better opportunities for attribution to digital ad spend, as well as the booming digital audio side. So all encouraging trends that while there's a minor blip here in ad spend, the consumers definitely seem to be pushing more towards digital. And for those companies that can ride it out, should be in a stronger footing coming out of this than they were even going in.
Yep. The pain is uneven and the benefits are uneven.
Absolutely. So on the MarTech side, pretty similar story in terms of number of deals. Saw another 60% down from last year. We'd been on a tear for a couple of years there with MarTech transactions. And interestingly, in Q1, they're still maintained a few scaled transactions, while in this quarter there really was only one with the Foursquare Factual merger. But the other thing about MarTech, which is very different than ad tech, is the business model, right? They're not subject to the variableness of ad spend. They're typically more SaaS contracts. Can you talk a little bit about what's playing on in that, and why we've seen M&A dry up in the MarTech sector as well?
Well, I think this one we truly can just blame it again on COVID. You're right, MarTech has this sort of more enduring strategic value because the quality of those revenues, particularly if they're software subscription models, have a higher multiple associated with that, and we've seen that in the public markets with some of the trading that we'll get to, really sort of off the charts. We have seen a pickup in dialogue, so we're positively hopeful for a return to activity here, though there is still noise. There's noise around identity parameters, whether that's cookie deprecation or IDFA, which was highlighted in this quarter, or quite frankly, on July 1st is the implementation of CCPI, the California and therefore U.S.-centric privacy regulation. So there's a lot of sort of moving parts in and around identity, which will have an effect potentially on MarTech deal activity.
Yeah, knock on wood for everyone in MarTech and the identity and data space that consumers continue to decide that personalization is actually better and decide to continue opting in. So moving on to digital content, this actually is the different story from the other sectors, and actually has seen a very strong quarter of M&A, at least relatively speaking. The aggregate number of deals is down for sure, but the number of scaled transactions has actually been pretty strong. It's above where it was at the second half of last year, slightly down from Q1 2020, which was a record quarter for scaled deals in digital content. And these really span the gamut, whether that's digital audio deals, both in M&A and some licensing deals from Spotify, mobile gaming deals, which we saw a wide variety of, and some CTV deals. So yeah, can you, what's happening in digital content that is so different? I mean, obviously there's some variability and some ad spend requirements there, but why are those buyers more bullish here?
Well, I think it's a function of, within this category, you're seeing some of these subsectors that are actually benefiting from the pandemic and associated lockdown. You mentioned it, whether it's, OTT video or TV viewing, streaming audio, gaming, e-commerce, all categories that are up materially in the second quarter associated with COVID. And I think what you're seeing, and will probably likely continue to see, is strategics just set themselves up here with deals to make sure they're positioned where the puck is going.
Yeah, absolutely. And I think the consumer side of things as well, whether that's how they're using it or also just e-commerce is the other sort of interesting consumer phenomenon here. And we're seeing that play out on the D2C market. So while brick and mortar stores are closed, people have started to adopt e-commerce broadly, which means they're generally adopting more direct-to-consumer businesses. And similar to digital content, has seen a strong quarter with a number of transactions and a number of scaled transactions. Can you just talk a little bit about some of the larger and more significant deals here?
Yeah, I mean, look, when you force people's hands, right, when they can't go to a retail store, this is the nirvana for the direct-to-consumer companies, provided they did enough financings to, stay alive during the slowdown. Because, e-commerce, as you mentioned, has picked up like 10 percentage points. So we're getting closer to closing that gap with China, and as a function of that, people who just hadn't tried online purchasing have now tried it, and it's hard to keep them on the farm once they've seen Paris. So I'm pretty sure many of the people who have now experimented with e-commerce, and in particular with direct-to-consumer brands as purchasing habits, are not going to go away just because COVID ends and we go back to work and people can go back into stores. They now know how much more convenient it is and how much great selections and customer service and delivery options they have online. So I think as a general point, this is a big shot in the arm for both e-commerce and specifically direct-to-consumer brands. Now, as we know and have noted, this is a very fragmented, competitive landscape where the outcomes are going to vary wildly based on the undergoing categories and, quite frankly, the underlying business models. If you're in the subscription direct-to-consumer market, that's a much better, business models. We noted two deals in the quarter. Grubhub in their deal, which it's most notable for not to whom they sold for, but to whom they didn't sell to, which was Uber. This one we think, would have created undue sort of market share, and potentially may have been challenged by the Justice Department, and that may have factored into their decision to select another suitor. But at $7 billion, that's a pretty notable deal. And the other is just yesterday, Mirror selling to Lululemon for $500 million. Here is a fitness equipment startup that really had just barely gotten off the ground, right? Just got some notice, good product in the market, but really just nascent in terms of sales. We would note that they did a strong job of building a brand using good old-fashioned digital and television advertising. So well done, Mirror. And quite frankly, when you think about the huge exits that these direct-to-consumer brands have had via M&A, and compare that to the ongoing challenges of being a direct-to-consumer and having to actually build a sustainable business model. Witness Peloton's downturn in their stock price when they announced that they were not going to make money for several years, and of course Casper's ongoing sort of market cap challenges. It will demonstrate that M&A is the exit of choice for direct-to-consumer brands.
Yeah, and it also highlights, taking advantage of local maximums, right? Mirror is certainly on a tear right now, but who knows how long that will last post-COVID as people start going back to gyms. Good opportunity to get a good deal, and we'll be interested to see what Lululemon's plans are for that business.
Indeed.
So moving on to the public markets, we've alluded to this a few times, but the public markets have been really a completely different story than the M&A side of things, especially for the sectors that we're focusing on, digital media, marketing technology. It's been pretty fascinating to watch as, MarTech, AdTech, even the large digital giants, all up, over 20% this whole year. MarTech actually up over almost 100% this year. So pretty crazy to imagine in a world where we have, 10 million COVID cases and even more deaths and the unemployment numbers we have, that companies are going up 125% just in Q2 alone. What we noticed is that there's a big divide here between those companies that are really technology first, maybe more digital, and those that are more legacy businesses, very people heavy, like the agencies, which have seen drops in their valuations over the last year to date. Although I would note that in Q2, coming from the bottom of COVID at the end of March, all companies have been up and have been up double digits in that quarter alone. The other fascinating part of the public market story is not just the growth in their equity values, but is also the growth in their multiples. So the MarTech sector, for example, has almost doubled their revenue multiples. So their enterprise value over 2020 revenue at the start of the year was about 8.5x for that cohort. As of today, June 29th or June 30th, actually, they are at 14x, so nearly double. And we've really seen this again across the board for those tech players, whereas others like the agencies and telcos have lost valuation multiples during this time. So can you talk a little bit about what you're seeing here and how you think this plays into the broader market and ecosystem?
Yeah, I mean, I think this tells a pretty clear narrative, right? Let's acknowledge that there is some distortion in these numbers because there's not that many public companies, and you get some outliers like a Shopify trading at 48 times revenue, even higher than Zoom. Hard to imagine. Distorting the numbers somewhat, but as you mentioned, almost all of them are up. I think here you're essentially what our point before about COVID and the associated lockdown having the effect of accelerating pre-existing trends, and this clearly shows that the shift from legacy to sort of challenger type business models is really parsed out on this chart. You've got the disruptors on the left, you've got the legacy companies on the right, and the relative valuations, reflect those positions in these sort of natural gestation of sort of the changes taking place to the broader marketplace. All the way out at the end, as you mentioned, the agency holding companies. I mean, look, it may not seem a lot, a half a point difference, but that's 30% off 1.7 times revenues, down to 1.2 times as the average for the major ad holdcos. And this, I think, is both a function of the fact that that sector is in sort of structural challenges associated with it, as well as the fact that you've got software workflow companies nipping at their heels, likely to take away a substantial amount of their revenues.
Yeah, absolutely. And I'd love to see the model that supports a 48 times revenue valuation.
Yeah,
that's a valuation I can get behind.
What assumptions do you have to make on a DCF to get to that number? It's mind-boggling.
You don't often see when people revise guidance down that their multiples go up. Well, this was great. And for everyone listening, there is a lot more to this report. We kept it pretty high level here. Really just wanted to provide some of the commentary that you can't see in this, but there is more detail on individual companies, public market performance, more detail on financings that happened in the quarter that we're not necessarily going to go into right here. But I guess just to close this out, Terry, what's the case for optimism as it relates to the M&A market and maybe the ecosystem broadly, heading out of Q2 and looking to the second half of 2020?
Yeah, so look, on one hand, you could say, wow, by the numbers, isn't this amongst the worst quarters ever? We talked about the lowest level in M&A since we've been doing this report, and that might lead you to believe think things are bad, but I actually think there is a very strong case to be made for optimism here, because I think we've hit the nadir in terms of deals. I see a return in confidence. I see a return of dialogue that will invariably lead to transactions. And I want to note that I believe, and we've noted this in our work from home webinars, that we're going to see a big bifurcation, a big split between what we call strategic deals and capitulation deals. If you don't have to sell right now, I wouldn't. I mean, I wouldn't want to run a process to force an outcome when there's still lingering uncertainty. As we mentioned, we think things are turning. We definitely are going to see strategic deals coming back. We may see some noise of capitulation deals, sell for whatever they can get. But this is not the time to sort of force an outcome, because anybody going to market's only going to attract the buyers that are being opportunistic and looking to pick up deals. I believe once we start getting some strategic deals announced, these buyers tend to act like lemmings, right? When they see deals getting announced, they'll say, the water's okay to get in, and that ought to lead to even further deal momentum as we approach the back half of 2020. So overall, you can hold your resume. I think things are looking pretty good for this market, and we at LUMA look forward to taking advantage of that.
Well, great. Thank you so much for joining me today in our first ever video market report. As I mentioned at the outset, this is available on our website to download, and please, watch this and send us your feedback. Appreciate it.